I wonder how Prime Minister Churchill would have described the markets ahead of us. As I can't ask him, I'll ask our resident Brit, Nick Themistocles, whether we're in for blood, toil, tears, and sweat.
Holy fuck, oh shit, it's a dinosaur! Jesus Christ, what the fuck?
Welcome, ladies and gentlemen, to another issue of the Grey Market Talk with Nick Themistocles, investor, chief investment officer, market vigilante, former trader, former chief trader. Nick, have I forgotten? Marvelous golf player, obviously.
Much more important.
To discuss markets, and I'm Thorsten, the humble market maker, who's just listening to the godlike figures in the market, like Jeffrey Gundlach and Nick Themistocles, what they can tell me what's going to happen. You heard it already in the intro. I was inspired by Nick's colleague, Harry, and if you want to check out Nick's channel, there are shorter videos, 20 minutes, 25 minutes, and he always using a prop. So that's why I thought I'd get my favorite cigars out, because you've seen it in the intro. I've labeled it blood, toil, tears, and sweat, because we are now in a situation where there are a lot of possible routes we can walk down. And Nick's latest video, which I enjoyed very much, was about the so-called blood indicator. And it's one of the most interesting concepts to think about. What can early indicators possibly tell us? What are these indicators and what do we have to look out for? So I'm handing straight over to you, Nick. Thank you for being my guest again today, even though we posted at the same time on your channel. So thank you for letting me host you. And let's start with the blood indicator. What the hell is that, Nick?
All right. Firstly, let me share the screen. And so you can see the blood indicator. It's over there. So my face is going to be pointing in another direction. The blood indicator is the thing in red, and there's a moving average, which is in green. So just to give you some perspective. So what is it? Basically, firstly, mathematically, it's just simply a ratio of 3-month rates versus high yield spreads. And of course, the logic has it that if short-term interest rates start to go down and spreads on corporate credit high yield start to widen, then there must be blood in the street. I guess that's where it got its name from. I just made that up, but I can imagine that's quite plausible. So therefore, we look for signs of a recession, if you like, when we start to see interest rates. So we know the typical central bank approach. We're worried about recession. So what do? We drop short rates. And when we look at the market, what are the things that suffer? Stock market suffers, and usually the high yield. So spreads start to widen. So when we see a widening in spreads and a reduction in short-term rates, this ratio starts to fall. But we've got to put it into some perspective, and therefore there is your moving average thing, which is this thing in green. So we need a trigger, and the trigger has historically been, it doesn't mean it's sort of trigger for tomorrow morning if there's a cross, but when the indicator crosses the moving average, there's usually a warning, effectively, that this thing in orange, which you can now see on your down here, which I haven't sort of spoken about, is the S&P. So when the blood indicator goes down and crosses the moving average, you'll see generally a fall in stocks. I would ignore this sort of beginning bit because the data on my trading view only goes back to 1997. So, if we look forward more in terms of this point here, when was that? That was the financial crisis. So there was a cross in the indicator, rates fell, spreads widened, and of course, we had the big stock market crash at the time. And then we have to go sort of a little bit more forward in time to say that there was something happening here into July 2019. And when did we actually get sort of a recession? We actually got it in COVID. So we had to sort of survive, if you like, a rally in the stock market, whilst this ratio was falling. But if you notice at the time, this purple line was not going down. I'll talk about the purple line for when we come to this next point. So I've been, since we did some videos from November, and that was the point where I said 5,200. The Trump thing is going to shake things up. 180 degrees to Biden, something's going to break. I repeated myself in December and probably in January and February. You're getting tired of it. And I was, throughout the time, looking at this indicator, waiting for a cross. And of course, we got fairly close. This red line fell towards the green line, but we never actually triggered. We only triggered the other day, it was end of February, third week of February, the blood indicator triggered. But again, I looked at this sort of purple thing, and I'm going to get rid of the S&P here so we can see a bit more clearer. The purple thing is the price of the junk ETF. So I think what you need is junk bonds to be falling as well as spreads widening in order to be sure that the market really is expecting a recession. And at the moment, although we saw junk bond prices fall a tad, they haven't really fallen very much, and in my view, not enough to signal that we have everything in place to say 5,200. So my sort of middle target was around 5,600. We kind of got to. We don't have all of the indicators saying we are likely to be in recession, because then I would expect bonds to reflect that, and they're not reflecting that in my view. And so for that reason, it kind of makes sense where we are. So now I would say, you need to watch for some other things that will give you confidence that there's a recession, and probably then you'll start to see this thing being reflected in junk paper or high yield paper.
Let me jump in here and ask you a question. As we have junk bonds, these companies who issue junk bonds are usually not the top cream of the market, right? So they are barely hanging on, doing their business. Most of them are not even profitable, right? So they live off financing. Can't they? I know it sounds a bit paradoxical, but couldn't they even survive a mild recession as long as interest rates come down and they can roll on their debt? Is that what we are seeing here? If people say, yeah, we're not going to get a severe recession, they're shite anyway, yeah, but they are going to survive. As long as interest rates are coming down, spreads are not going to widen, because they can perpetuate their bad business model into the future, what a lot of these junk bonds have done for the last, let's say, 20 years.
There are two things there. One is survival and the other one is price, right? So survival means someone will give you the money. Okay, so you go in and you say, hey guys, my business model, it's going to work eventually, but I need some refinancing. Of course, the capital markets frenzy to lend money to these people at a nice spread. But that's the point, that if they're going to lend to you because they believe in your down the road story, then they'll charge you something, and you'll see that being reflected in lower prices for the junk bond paper, plus a wider spread for the junk bond paper. And at the moment, spreads on double Bs, I think they're about 200 basis points. On sort of high yield, they are there or thereabouts at 300 basis points, and that's kind of, it's okay. It's not a disaster. So when we look at the state of the market today and we say, well, Nick said it, Trump has shaken things up a little bit. The market now has figured out, I don't know what's going to happen. So now they say, I can't hold something if I don't know what's going to happen. So they all run to sell this, these risk assets now finally. But the point is, they don't have all the information. And I don't think the market has all the information. Our last video, I think you titled it, Nobody Knows. And it's absolutely true. Nobody knows right now, right? And I'm sure some of the inner circle don't know, because, if how Trump behaves, how severe the tariffs are going to be, his negotiating style, whether or not this sort of war discussion is in the background that he's trying to fix, and what his priorities are. So they all know the toolkit. They all know what is going to be used in terms of trying to get the economy going and more balanced global growth and more balanced American growth and less dependent on government. We know all of that, but they don't know when and the severity of the guy, and how he's going to implement his strategy. So we know
So
a
what,
lot of the bad news.
Nick, what we're
Sorry.
seeing here is there a lag between prices and your blood indicator that one could say, okay, fine, we've seen it now. It went through the green line, it went through the averages, and credit markets still went, or bond prices for junk still went up for a while until they finally didn't. Because we discussed that not the whole last year, but it cropped up in conversations. This proverbial debt wall coming in, that corporations who refinance at zero interest rates, allegedly to all the market pundits, that would have hit the market already midterm last year, and nothing happened. Now we're again, and we have this big rollover. I think it's about 10 trillion in short-term government bonds, and I've heard the number of 7 trillion in corporate debt, which all might hit the market at the same time. Is that the proverbial, how do you always call that? That is the canary in the coal mine here. We haven't seen the turkey in the coal mine yet, but would it here be prudent to say, yeah, I might start building up my first positions?
Well, it's always prudent to do something when you're uncertain, and the uncertainty began in as I say, for me, the uncertainty began in November, and gradually, actually, I became sort of it reached a point when so much bad news is out there, as it is today. I mean, let's face it. So you got somebody who is playing around with global trade, and it's very difficult, even for the experts. I mean, there was I don't need to plug the guy because he's so well known, but Brad Setzer was recently interviewed by Jack Farley, and he explained how these tariffs could impact. And I heard an expert talk for an hour about something, and even he was saying, well, look, there are a lot of unknowns in exactly the response. Of course, and rightly, we don't know how China's going to respond. We don't know how everyone else is going to respond. We don't know to what extent the impact of tariffs on reduced growth in America will be compensated by lower tax. And we know that Trump has got a tax bill running its way through the processes in America to get stamped. So we have no further clarity. And so for those people who were invested on the back of Trump's in its all brill, and we can stay long. Well, they've had to reflect and say, well, actually, we don't know. We don't know when. We don't know the sequence. We don't know the severity. And we don't know the reaction from the other side. So for that reason, a lot of people who have been in it's a no-brainer trade, Trump, God be long, have had to exit. But for the people who are, still of the view that American companies are still going to function, that there is no way that this nuclear option, right, of everyone's pushing the tariff button this time, right, where you impact global trade. It's not good for anyone, right? And actually, it might help the Europeans, who I wasn't aware they had so many tariffs against America. So, and I mean, you think about what a tariff is, it's protectionism. So it's not really protected the industry in Europe very much, certainly not Germany. So they could actually, it's probably a good conversation to have with Trump if you say, well, okay, we won't charge you if you don't charge us. I mean, that might actually force a different behavior from industry, and it might be something more positive and more sustainable. So we don't know how these things are going to play out. So you say then have I got a trade on now. Well, I'd say the first trade was down to 5,600. Done that. That was the easy trade. Okay, what's the next trade? The next trade is not so easy because we still don't know the sequence and the severity and all of this stuff. So that's number one. And number two, from a purely technical position, what have we done? We're still in the channel. We've reached the top of the channel. We've reached the 200-day moving average from underneath this time, as it were. Bitcoin is also sort of straddling, or was straddling, the channel before I had a little bit of excitement today. So, from a technical perspective, I would say the market is still erring on the cautious side, on the more bearish side. And then, of course, if, let's just say April 2nd comes and goes and people say, might get to a little bit of relaxation. But then the market needs to reorient itself into the positive aspects of what Trump is trying to do. Get bureaucracy out, get tax cuts in. So people will start to think about that compensation. Today, they're not. Today, you can see from price action, they're all focused on the downside of tariffs, and that's it. So the trade is still erring on the sort of negative side, but is it obvious? How far does it go? I don't know. And I asked you, in the green room, is it time for one of your straddles? And you said, no, not here, Nick. Don't do that, son, because it's a bit expensive. So I think it's probably not time for a trade, really, is it?
Yeah, well, if I listen to you, and also I'm not a fan of tariffs. However, if you hit the history books, the most prosperous growth time the United States had in its history is when they didn't have a Federal Reserve, where the currency was backed with gold, where there was no inland revenue, and they financed the state, much smaller state, exclusively with tariffs. Yeah. So the one thing Trump is missing, he has to abolish the inland revenue.
Yes, but in order to do that, he's got to make his tariffs work so that he gets paid, and that substitutes the tax that they currently receive.
The problem with the negotiations, especially with guys like in the European Union, they say, okay, fine, we roll down our tariffs against American products, so you roll back the tariffs you just exposed us to. And then they do that, and then the European Union introduces something like, import as many chickens into the European Union as you like, but they cannot be washed in chlorine. They come up with stupid rules that you say, there are no tariffs, but there's actually no way that you can really plant your products in the European Union when the leaders don't wish so. So I think Trump knows this whole scenario they're playing out. He's using it to give them the stick. The price action because I'm still, that's why I wanted to talk about this chart first. If I trade the AYG, the high yield ETF in there, and things turn out really well, we do not see a recession and interest rates are still coming down because I don't know why, for whatever reason, interest rates, is there a huge price upside potential in the HYG, because these is the kind of trades which I like for their asymmetry, right? I don't see a huge potential on the upside, but an enormous risk on the downside. So how I would ease into a market, and I've been wrong before, to say, let's sell a call spread out of the money, see whether that thing starts making money or not. If not, it's too early. However, if you start making money with this, then maybe it's time to say, we should take the blood indicators seriously, because there is a lag. We've seen that in the past coming in that is neither good for the bond market nor for the equity markets we have in here. What's your view on that?
So the people that play the HYG, I think the game for spread tightening is pretty much over. And I say that sort of separate to a discussion of should credit trade above governments in this environment or not. That's a different discussion. But generally, I think the big spread tightening on corporate paper, that aside, is pretty much over. But for people who are involved in fixed income, they're in it for the carry. What they are worried about is a time when there is likely to be a recession, and then suddenly not just they experience the spread widening, but they also experience defaults. And that's kind of the first bit about these high yields at this very, very tight spread. But there is another aspect to this, and there's a chap called George Robertson who is a very clever chap, and he's been, he has a service on Substack, and the way that he views it is through distance to default. And so he goes through, where is the spread? Let's put it through the Merton model. Let's look at the distance to default, and based on where we are, which regime we are, tells us as investors whether something like the Russell 2000, so he uses a double B corporate spread as a synthetic cost of what a company in Russell 2000 would be charged. And then he would say, well, okay, well, if I know the spread of where the corporates are paying, then in theory, I should be able to compute where the fair value is of the Russell. And so working backwards from the spread and what the market is pricing in terms of distance to default, it basically the conclusion today is that the Russell has value, and therefore the stock markets are likely not. You should be buying. So strategy would be, so you should be buying the dip. What the dip is, how far, and how much you want to put in, is a different thing. But the spread basically gives you the answer: is an investment in the stock market making sense to where credit is being priced? And I'd say that that's a kind of a sensible approach. And I would say that fits in with the logic of, did the blood indicator trigger or did it not? And is this just another kind of, it's a nice rule of thumb, but unless you look under the hood, you don't really see it. And as I showed, I think I've just stopped sharing. As I showed in 2000, where were we? I need to put the S&P on. So here we crossed into July 2019, right? What was high yield bond prices doing? They were going up. So they were going up, stock market was going up. And it wasn't until we had a COVID hiccup that effectively then all hell broke loose. But the point was that the indicator, it's a useful thing. It kind of puts you on alert, but I don't think it can be used without some kind of intellectual overlay and say, yeah, okay, what's going on with high yield spreads? What's going on with high yield prices? Are they widening? Are they tightening? Is this reason for the, same thing with the inversion in the yield curve? Was that really telling us that there was a recession? That you need to look a little bit deeper. And I think in those days, and probably still today, you need to question whether the indicator is telling you that there's a problem. And for me, the way I read it is, I don't see the problem. When I look at the calculations from George, ignore the fact that I have a problem with the calculation, but I think the principle of what he's saying is absolutely spot on, that there is no reason for alarm if you are kind of a long-term investor, or if you want to buy the dip and things like that. I mean, like everything else, manage your risk, but it's just another thing you need to look at rather than, I mean, I put this out there because I've been following it, and then it triggered. And then I said, well, what do I do now when it triggers? Do I just accept blindly that, it's game over? And then, you do your digging and you say, well, actually, no. But I know that hedge funds use this thing. I know that some institutions use this thing. So therefore you think, well, okay, then I'll use it as well, because that may well be forcing some market flow. I mean, just because I don't think I would sell on the back of it doesn't mean other people aren't selling on the back of it. And so we have to understand the psyche of the market and whether or not we should go against it, or when we should go against it.
How many of these negative indicators can I actually add together and still keep on ignoring them? That's what I'm asking myself all the time. Buffett yardstick, yeah? We are very highly valuated. Earnings per share, revenues per share, earnings per growth, still high valuation. in the markets. Yield curve has told us for ages now, get out, get out, get out. We even had the steepening, and the past had always happened. Yields, high yields, now telling us, okay, there is something on the street. Then all the tiny little, and I know you hate that, the data points coming in every week, consumer confidence and whatever, yeah. Also painting us a bad picture. At one point,
Yes.
do I say I've stopped buying the dip? And that would be my next question. Is it just liquidity driven, Nick? As long as there's fresh money sloshing around, whatever happens, US goes up.
Well, this discussion we had also a while ago when we talked about the theory behind why liquidity is important, and therefore, coming back to your question earlier, if a Russell 2000 company can borrow money, there's things going on. They will carry on regardless. So the ability to borrow money is important. But understand the person making a decision who might be looking at consumer confidence, which is coming out today, or these other things that the Fed might want to look at to make their decision. The person making a decision to lend money, you also have to understand how he ticks, because when these people start to say no, then you'll see it in the price. You'll see it with spreads widening. You'll see it when, there will be data points. And I think, I'm not going to poo-poo my own indicator, as it were. It's not my indicator. I cribbed it off someone who cribbed it off someone else for sure. And but when these indicators are formed, they are plausible until they're not. And then, you have to, as we say, the informed user needs to, I think, do further digging before he blindly accepts an indicator. But I know that this thing, I saw this on Twitter the other day after I'd already discussed it with a client, saying, hold your horses. There's, don't panic here. And that was on Thursday before the market ripped higher. That there were people saying, oh, I was breaking loose. That was when we were at 5.5, or what was the low? I can't remember what the low was, but you had this sort of, it's broken through. I'm like, okay, that's someone looking at an indicator without being informed. And I think you just need a little bit more of a wider view. I don't know about other indicators. I treat them one at a time. I treat sort of, we know that consumer confidence is bad. Why is it bad? Because nobody knows what's going on. I mean, so it's not really a time for confidence. We know that the uncertainty index is very high, but usually when there's blood on the street, sometimes it's a sensible point to jump in.
Could you do me a favor and scroll out again, that we have the financial crisis in there?
Yes. So I think that was here. And as you can see, you see what bummer. So both the HYG and the JNK, they both came into existence December 07. I mean, that's like a tall building thing, isn't it? That they should. It's almost like, I won't say it's like a Bitcoin ETF, but it's almost as if the whole market was going absolutely. I remember, I was how should we say, in the game at the time where the market was really crazy for give me some yield stuff. So they invented a couple of indices, the JNK, the HYG, all roughly at the same time, happened to coincide with the point in time when the indicator had already crossed here. So when was that? That was in July of 07. And unfortunately, we don't have a price history of what was going on with high yield credit. But my guess is that there were probably some warning signs.
Or slowly drifting down. I think I might remember that. Yeah.
Absolutely. And so when you look at that price action, you'd say, yeah, in that case, indicator triggered, prices are heading lower, spreads widening. Is this the time to buy the HYG or JNK in December 07? And you would have said, surely not. And it would have saved you a ton of money.
Could I use that indicator also, instead of a blood indicator, as a party indicator to say, yeah, it seems to be reasonably well working when we cross the line from the top. And if I look at this chart, I would have been in a hell of a ride on the upside every time I would have done the long positioning when we went through the red line, went through the downside of the moving indicator.
But have a look when it didn't work. So if you have a look here, there was no look, the moving average was absolutely torn to shreds because of this COVID thing. Yeah, this thing which moved the spread of 3-month rates to high yield. They came down so sharply that the moving average was so low that there was no way that you could actually see, when things were starting to turn bad, which was in 2021. So, things are never perfect. You should never use just one indicator. They are useful guides, but I put it out there as pretty much a response to the people who are jumping up and down saying, line goes through, therefore kill. And I'd say that just a little bit more underlying analysis is required. And, where the high yield is still okay. I mean, today anyway, I don't know. It's still okay. So I would say, should I be worried? No. Because then I turn to the analysis and the type of work done by George Robertson to say, well, actually, if the high yield is saying things are okay, let's look at whether or not the distance to default suggests that equities are cheap or not. And I quite like that kind of discussion. I think liquidity, come back to that liquidity debate, and it is very important. So where is liquidity coming from? It's coming from China. Is coming from the Germans and the Europeans. The whole time they could have done something, and they waited and they said, okay, now we're doing. So it's coming from them. I mean, we don't know how successful they're going to be with their decisions, or whether the courts allow, or somebody says no, you're not allowed to, or whatever. And is it coming from the Americans? Well, I mean, there's a strong possibility. I mean, one of the things I wrote a couple of weeks ago to a client was, the Fed will have to reduce or cease quantitative tightening very soon. And what happened was, next FOMC, they reduced it by 20 billion. And I think, so you can see that there is a kind of the direction of travel for liquidity is more in the sort of line of improving. And then we just need, with China, with Germany, improving their economies, with, Trump, we're going to have a hiccup. I mean, it looks like we're going to have a hiccup in the economy. But maybe the Fed balance that out. Maybe the tax cuts balance that out. We just don't know. And I haven't sort of been, I'm ready, just about to do an analysis on global PMIs, but, rising PMIs, rising money supply, it's all pointing to perhaps we get more time for this market, and time is really important thing in this thing, because I sort of look at cycles, because we are heading to that time where I said, end of 2025, 2026, where this real estate 18.6-year cycle is going to come into play. And then, you've got a lot of headwind, irrelevant on what you're trying to do. So, this is just something to bear in mind. We need time. We need to survive this year. But I think next year is going to be very shaky.
So the big, how do you call it, 500-pound gorilla in the room. We haven't talked about that, actually. We talked a lot about the indication we'd like to see on the spread side, on the high yield side. Is there going to be a recession, Nick, or is there not? Because if you would have listened to me, we are now well into the second year of the recession. And we haven't had it, at least officially not.
I think the answer to that question is very difficult, because
that's why I'm asking. That's why I'm asking you.
Consumers are shaken. consumers have definitely been shaken by what they're seeing. And so for those people who were, and we know that there are a lot employed by government who aren't sure about whether they're going to be having a job in the future, whether their department's going to exist or whatever, irrelevant whether it did anything. They are part of the people who go and buy stuff. And then you say on top of that actually the imported stuff is probably going to be 20% higher or thereabouts. Perhaps the Chinese devalue, maybe they do, maybe they don't. I don't think they should, but irrelevant. And so perhaps these things are going to be really expensive in the future. And you say, well, in theory, I should go out and buy a shed load now because prices are going up. Are we seeing that? I don't know.
I don't like that line of reasoning because all pundits on television are like, oh, yeah, tariffs makes everything so expensive. That is true if you're North Korea and you don't produce anything yourself. But we're talking about the United States of America, independent in food, energy, still do marvelous stuff over there. Yeah, okay, fine. I can't buy a BMW anymore because now it's 25% more expensive. Or I don't buy French red wine. I go to Californian wine. The normal things of life, the American who voted for Mr. Trump will not see the big difference there. Yeah? He buys a Ford pickup truck and she goes to, I don't know, Chipotle for a nice dinner. There is no Red Lobster anymore, which was my favorite every time I was in the United States. Lobster all you can eat. In Germany, it was for really rich people who only have lobster. In the United States, you could just totally pig out. Anyway, I'm getting on a tangent here. So what I'm seeing in all this doom-mongering, which is going through, inflation will be so great. Well, don't buy European shit. Don't buy Chinese stuff. As long as you can produce it in the United States, you have all the resources, you have cheap energy, you have all the food you want. The others are in trouble, not the US.
So you bring up a good point. Firstly, the inflation thing, it's a one-off. That's not inflation. Yeah. Secondly, if the Fed talk about tariffs as being, it's inflation, raise rates, then I've got to say, shut them down, because that's just stupid. And the other thing is about these consumer surveys, which I've seen, actually, when you dig a little bit deeper, you find out that the people who are one way were Democrats, and the people who are okay with it, say, oh yeah, I'm going to buy Californian champagne, so the people who kind of just say, okay, well, I'll just deal with it, right? Republican, and the people who say, well, stupid thing, tariffs, Democrats. So these surveys are also somewhat misleading, and therefore you must treat them with some pinch of salt. But comes back to the video I made with you in November and thereafter. Nobody bloody knows, right? And I think this is all part and parcel. You said go and buy a Ford. Okay, well, Ford stock fell yesterday from what I sort of heard on the headlines. I haven't followed it. I don't know. Maybe it's gone up. But Ford fell. Why? Because the tariffs also impact imported parts, yeah? So everyone was really clever in these car companies in the past, where they say, I've got a great idea. Americans, they charge too much for their wages. Let's go and, get the stuff from overseas. And they go and get this stuff from overseas. And now Trump comes in and says, right, if it comes from overseas, you pay a tariff. And of course, that's not going to be very clever for Ford. So they won't get away unscathed, even though there are many things made in America that you're absolutely right. This is the most brilliant thing about that country is that they are absolutely, as you say, secure in food, secure in energy, and they are geographically separated from anyone who wants to cause trouble, by miles.
The North Korean call that the Yuhei philosophy. Yeah, that you're totally independent, food, energy-wise, can do everything yourself. The Americans have it. They do actually have it. Now, I'm with you on these points, yes, and I think we owe that to the Japanese. They started this whole just-in-time marvelous stuff in the 80s, and for a globalized economy, fantastic. If we scale back on the globalization, yeah, you run in trouble. You have to readjust. You have to suddenly, how do you call it? Not outsourcing, insource again your products you have in there. It's great that we agree on the inflation side because for several reasons, I think, yes, that was a one-off we've seen. Secondly, if we get a recession, we don't see inflation. Yeah, it's not going to happen. When
Correct.
nobody buys stuff, we're not in a stagflation scenario. I can't see that. One of the things we discussed in the green room, where I have, I read a lot of books, and not just science fiction novels, but also interesting things. And Richard Koo, the chief strategist of Nomura, he was the first who actually, I think he coined the phrase balance sheet
Yes, he did.
recession.
Yeah.
Yeah.
I have his
And
book as well.
just for viewers who haven't heard it before, balance sheet recession is what Japan went through. Yeah? The economy faltered. The state tried to make money as cheap as possible and pump it into the economy. And all these companies, you know what they did? They didn't invest. They paid down their debt. And there was no money sloshing through the system anymore. And I've never heard anybody talking, is that something which could be on the cards for the United States? All these companies are highly indebted. If we have a bump on the growth side, interest rates come down, the magic bullet seems to be, we spent liquidity in the market and the corporates will invest and everything will be fine again. What happens if they suddenly start, you know what, we're paying down our debt because I don't want to get fired or I don't want to lose my job in a zombie company. And then we would have, which would also with the statistics fit nicely in line. You've heard that before, the lost decade. We always have a mean reversion in equity markets. We can't make 25% every year. And we've done that for a while now. We had an enormous return just on the S&P. It's time to test a bit the other side of the bell curve. Doesn't mean everything horrible might happen. It's just the equity markets are not going up.
Well, we should remind everyone, we certainly did last year, that the equity markets are not the US stock market. I mean, I know that the way it worked last year was the only thing that people cared about was the US equity market. And you care about it because it's it's your direction. And up until now, there was a jolly good reason why people with dollars would go and invest those dollars in American companies. They were making profits, whereas the European companies were, not. The economies were not. The American economy was going great guns, whether it was, we don't care whether it was on the back of government spending or private spending. There was money in the system, being pumped in. So there was a reason in the past for all of this stuff. Well, and the thing that we talked about all of last year and probably before that as well was that there are other equity markets out there. And, nobody's been investing in China. I mean, because they're worried that it's uninvestable. She came out today, President Xi, and said China is investable and stable. Okay, so he's basically seeing the opportunity of people who have all been one way, including a lot of Chinese investors. They're saying, we don't want this one stuff. We don't want this Alibaba stuff. Look at it. Look, it's not going anywhere. And actually now they have a reason to, to bring some money back home. And that was the rationale for my sort of bearishness for most of last year on US versus overseas, was the fact that there were some jolly good reasons to go and invest in Europe, Asia, because the potential for this ever-growing economy was dependent on one thing, and that was the ability of government to continue to pump money out. And you see, what stopped the government was not the ability to refinance. What stopped the government was a new president who said, holy schmoly, look at that 7% budget deficit thing. That can't be good. And of course, the modern monetarists are saying, what's wrong with it?
Why bother?
What's wrong with it? Who cares? Who cares? Because the dollar is still the dollar, whether it comes from the government or some corporate. So, okay, so the modern monetarists were very happy that, and it kind of works because, well, it did work, certainly for the Americans. I mean, you can't really do that in Europe because, but look at the Liz Truss episode. Yeah, you can't really do that without somebody getting a bit narked and saying, "I'm not going to buy your stuff." But in America, you can, I think. And but Trump has come in and said, "No way, we're going to get that down to 3%." Well, if you get that down to 3% as a deficit, then and you had 7, so you are now basically taking out 4% of money, real money, that was going into the economy. So your GDP is already minus 4%. Forget multipliers and all of that complexity. So how do you make that up? So you have to find something. And so the logic, and it makes an awful lot of sense if you are sort of thinking this way, Scott Bessent says, I've got a great idea. Let's stop the spending from government and let's just grow the economy so that companies are generating all of this growth because that's more sustainable, isn't it? Absolutely spot on. But like this sort of transition, we heard about the energy transition, you've got to have a plan for that. You've got to sort of ease your way out of what you were before to where you're going. Otherwise, you will have this, before things take off. So any transition strategy, I don't care what it is, I want to see a plan to say for every dollar you take out here, there's a dollar coming in from somewhere else before you start to pull too much on this line and create this thing. And of course, Trump's team is Trump's team, but are they thinking about this? If they are, they're not being communicative about it. And one critique I have of them is I don't think they're being very communicative.
That's what I meant, because you're absolutely spot on. The corporations have to play this game then. They have to invest. What if they pull the rug and simply say, you know what, fine, we're not spending as much anymore, but I'm being more on the cautious side. Like we've seen in the big energy stocks, when they were completely out of fashion, what did they do? Pay huge dividends, hand money back to the investors. Say, yeah, no, we're not investing in any evil stuff. Nobody wants tobacco industries. Pays huge dividends to their shareholders. If that would flip over into the real economy, that people say, yeah, fine, we do the right thing. Finally, we are reducing the deficit. But you know what? If you start reducing the deficit, I'm also reducing my corporate deficit. And then we have no growth.
You're absolutely right. In theory, on paper, that could happen. My view is Trump is basically incentivizing these guys to make money, because I think, and this is where I think is a shame that he led with the tariff thing, because tariff was one of the tools in the toolkit from Stephen Mirren's paper that he published in November or October, whenever it was, is one of the toolkit. But of course, the other thing you can do, if you want to get companies to go and make stuff in America, put your tax rate down to 10%, 15%. They'll come, right? You don't need a tariff. Forget it. We'd have had 7,000 on the S&P already, right? People would already be, all the German companies will be, I'm going over there. Yeah. And then the Germans will then be coming to the Americans and saying, we'll drop our tariffs, as long as you have a fair tax policy. Or the Germans might even cut their taxes as well. We might be in a different game, but unfortunately, I think the mistake was he led with tariffs. And I think that's where we got the hiccup.
Well, thank you for assuming Germany could do something sensible. Now that we have an almost conservative government, and the conversations now going on into the coalition are raising taxes. So they haven't learned their lesson. It's an absolute disaster what's happening.
They just don't get it. I mean, if I must say I don't follow closely enough
it has reached a level of absurdity, Nick, I do not understand anymore, because at least Mr. Merz, he's a clever guy. He used to work for BlackRock. He was a successful lawyer. He knows how industry works. What's going on there? If taxes would be the solution to make a country rich, we all would have already 100% tax rates by now. Somehow it doesn't seem to work, right?
Yeah, indeed. I quite like, as I said before, some of the things from Doge. The inefficiencies, the corruption is great. Every country should be doing that. If they want to tax people, they have to show that they are good stewards of tax money. I think that's a sensible approach. Obviously, it's all happening in one go. That's why everyone gets narked. But you should be doing this every day. Who the hell has been watching this stuff all these years? What's the point of having 100 congressmen and all of this? What the hell? hello, and all of these MPs, and so on and so forth. So, be a good steward, and I think people will think more highly of politicians. So I think that's a good thing. But this tax thing makes people kind of, I don't know. I mean, it makes people lazy. Doesn't encourage people. And the more tax you put on it on your economy, the less likely people will be entrepreneurial. So I've come from that sort of way of thinking. I think
There are
Trump
some
is right.
studies. I think Mr. Laffer made. Obviously, the Laffer curve. Yeah, you have exactly one optimum tax rate. Laffer curve is simply, it says if you have a 100% tax, you don't have any tax income because people are not working. If you not enslave them, or if you have 0% tax, there is no tax income because you're not taking money away. So somewhere in between, however the line wiggles, must be a point which is optimum to get the most tax receipts. And they came out with studies with about 15%. That would be a flat tax, which would be most beneficial for the state. Obviously not for the entrepreneur, but for the state to get maximum tax income out of it. And we are far away from that. We are miles away from that in Germany anyway. But in the scenario we just described, we are not longer in the Goldilocks for the time to come, Nick. Do I see
No,
that
I agree with
correctly?
that. I mean, I think that's right. When the market left 6,000, if you look at the kind of the bottom-up analysis, which I do on an array of ETFs, we quickly dropped into towards the recession, stagflation kind of boxes as people started to interpret different things of what tariffs mean. And it doesn't mean because bottom up, it looks like we're in that zone that the market is right. I just think, the long-term signals are in certain places not pointing in that direction. But for now, we are, how should we say, in this, once you go down so far, 10% in a market, then I think even, strong bulls would be questioning just how much money they want to have allocated in the market. And that's why I think this is all about the communication, this complacency, in my view, from Trump Besant to say, well, you had 20% last year. What are you worried about? Or the year before. I just think that's the wrong statement. And you should not be talking like that. You should be explaining how great the economy is going to be because you've got a tax paper which is just going to get approved, which is going to sort of do the other side of and so on. So,
well, one of the things we must never count out, American exceptionalism. I still believe in that. Yeah? I saw years ago this fantastic advert. I think it was for a car company and a very famous actor. And was like, yeah, we went to the moon and we even brought a car. And you know what? We left the key in it. Why? Nobody else could get it. That's it. And I thought, yeah, that's cowboy attitude. I like that. I always like that about America, that they have this ability to look forward and say, yeah, we're getting stuff done. Things we used to have in the UK, we used to have in Germany. I don't know whether the Frenchies ever had it, but it seemed to have disappeared. So on a longer term basis, I think, yes, it's cautious. We have to see how this whole thing develops. I don't see new all-time highs at the moment, not at all. On a tactical side, I think the market is, famous last words, quite predictable at the moment. You just have to look at volatility does, and then everybody and its stock seems to do, let's play the moving average trading game. Have you noticed that? Yeah, we dip at the 200, then we go up to the 50 again. Then if we don't take it, we go in the other direction. It's almost mindlessly dumb, well, trading action.
but it's good for kind of the traders in the market to who are able to
Yeah.
be nimble and look for points where they come in and go out, and I think that's kind of healthy as well. But the long-term players, I would just simply say you still don't know enough. And at the moment, even though I've been sort of negative from the top, at this level, I would say we should wait and see the positive stuff that comes out of Trump because I think, it's been a little bit OTT with the over the top with the negative stuff.
Did you see that little video I made for Katie when she asked
Yes, I
whether she
did.
should start investing now? I love this question because in the long run, yes, of course, it's always time to invest as long as you believe that we are in a capitalist system. Go ahead. Don't worry too much about it. There are certain points because we spoke about that Falks indicator who is employing, I think, about 40 sub indicators in there. He took us out of the market just in time, and we are not long again at the moment. So I'm staying cautious.
Yes,
Last
I
question
think
for next.
caution is right. If you're in, do you panic? If you're not in, do you wait? If you're short, this is fascinating time
One,
because
one, one last question, Nick.
yes.
Gold. Is it time for a breather or who cares? Just get in.
Well, my sort of thinking on gold is obviously structurally, there's nothing wrong with gold. Yeah, I mean, it's above all your whatever it is, indicators and everything is fine. But if you think of the rationale, why were we looking at gold? Why were we looking at Bitcoin? Well, initially, these were monetary hedges. So we were expanding the money supply, we were expanding liquidity. And why were we doing this thing? Because government deficits were out of control. Now, forget what Europe is doing today, and the Chinese had a different type of problem. But what are the Americans doing? They're actually trying to fix it. So, there's a real question mark about whether or not the Americans are going to continue to play that liquidity pump that was being played under the previous administration. And so for those people in America who wanted, inflation hedges, is there a need today? The money supply in America is growing at below 4%, which is well below where it should be growing to have this 2% growth, 2% inflation, and 1.5% or 2% of negative money multiplier. So you need 6%. Well, 5.5% to 6%. We're still well below that. For that reason, and there's no indication that that's going to extend higher. Where's the rationale for a monetary hedge? So therefore, the reason for the hedge is now no longer a monetary hedge. You're hedging now because of gold, because of fear on war. You're just putting it because there's a lot of uncertainty. So the rationale for holding it has certainly changed to what it was before. And as long as you're comfortable with that, then, fine. But know that you are, this thing is.
Well, I've been bullish for a long time, and I called it out and I said, okay, we are going to see the 3,000 simply because somebody wanted to ring the bell here. We are right now, and I'm getting a bit cautious now. Not on the long run. Yeah, in the long run, I still believe in how much has the dollar lost over the last 100 years? 99% of its purchasing power. Yeah, all paper currencies go to zero eventually. So gold is a good investment, not just for you, but for the whole family. Eventually. But on a tactical trading perspective, now I think there's time for a breather. I just wanted to, when you confirmed that actually, because I agree with you that the motivation has changed a little bit. Inflation is not a biggie. Corporate debt, especially in the case of the United States, might not be a problem if that is handled properly. And the buyers, the marginal buyers, the central banks, I think have soaked up as much as they possibly could. And now it's the tail end again. It's the retailers jumping on board.
Yeah, the marginal buyer, right? Exactly right. And I was doing some work this week on central bank reserves, and and it came up also in the interview with Brad Setzer that the rationale for holding dollars as a reserve has basically, everyone who wants it has basically got it. And it's only the smaller sort of emerging markets that probably still don't have enough, including people like Argentina. But they've substituted a lot with gold up until now. But again, why do you need reserves if you're a foreign central bank? You need it to pay your way in case you just don't get access to this stuff. Well, I mean, the Chinese not only have the highest sort of foreign reserves, but they also they're worried about getting oil, they've got tons of oil, in strategic reserve. They're worried about copper. They got loads of copper. So the Chinese are almost they are, I won't say war ready because they haven't so far had any wars, but they are self-sufficient. They filled up their cellar and they say, well, I can go in there for 6 months and it should be no problem. So the question and the rationale for more of this stuff, perhaps with some central banks still to do, is quite possible. Perhaps with all this geopolitics, this de-dollarization, perhaps that still leads to more flows. From a technical level, when we looked at this thing, there is this sort of rule that I learned a while ago that if you break a high, which has lasted for many years, and the previous high was, I think, 2011 in gold at around 2000. If you break that high, then the first target is times 2, right? That's the first, so 4,000 in other words.
Yep.
So ultimately, this thing is going to 4,000. But shall I tell you what? There are some stocks out there that if you choose the right ones, they'll double as well, and you won't have to wait 10 years for it.
That's true. Nick, thank you very much. You enlightened me again, as always. I think I can follow most of your explanations. Yeah, well, it's difficult for a former market maker to follow the strategic views out there. I have a couple of trades already selected out of that. Sum it up. Yeah, I want to sell call spreads on HYG. Obviously, we're not giving any recommendations here. I'm being a bit more cautious on gold, and on the S&P. Well, it's a trading range. We've defined our gamma levels that seem to work quite nicely at the moment. Look at the moving averages for trading purposes, but the golden times seem to be, unless things change dramatically, over. We're not longer in Goldilocks world anymore. Nick,
Yes.
any final words?
And I repeat this from, I've said it for the last year and plus. If I were to overweight any kind of equity market, I would still be overweight in China. So perhaps I'm willing to take the geopolitical risk personally, but I think the opportunities are there. Someone at the door, and look, the sun's shining. You can see that on my screen here. So what a wonderful thing that is.
Nick, thank you very much. Thank you, everybody, all of you, for, I don't know, how long did we do today? Over an hour again, I think, something like that. Thank you for being our guests. And my recommendation again, if you like the shorter, bite-sized bits, go on Nick's channel, 20-minute videos, fantastic stuff. I love it when it comes out, especially I don't have to listen to myself. Nick, thank you very much. See you soon.
Welcome.
Bye-bye.
Bye-bye.